So, would you rather pay tax on a teeny tiny seed, or would you rather pay tax on the bountiful harvest? We're going to talk about Roth IRAs and Roth 401ks, but before we do, I want to share with you, my grandfather was a farmer, thus the analogy. And I like to think that I got some of his what he would call horse sense, his common sense. And I'm going to share some of this when it comes to something that a lot of people feel is very complicated. So let's jump in and see if I can take this financial concept and put some of my grandfather's horse sense into this conversation, right? And the way I opened with, pay tax on the teeny seed or a big harvest, of course it seems like a leading question. And you're going to say, I want to pay tax on the seed. And that's what I would say as well. But the answer is, it depends. It depends on your situation. If your tax rate is actually lower when you're doing the conversions or lower when you're putting the money in than what your tax rate will be in retirement, you may want to not do a Roth IRA. You may want to not do a Roth conversion. So let me start off with a simple example. Let's say that we have $100 and we're trying to decide, do I put this in a regular IRA or a Roth IRA? And the math will work the same for a 401k as well. So I've got $100. If I put this, it's earned income. If I put this in a regular IRA, the government will treat it like I did not even earn it, right? I put it in pre-tax dollars. So that $100 goes into the account, and let's say 10 years later it doubles. And let's say that my tax rate is 20% later. So I put the money in, I have $100 in the account, and then 10 years later it's worth $200. I take it out, I pay my 20% tax on it, and I'm left with $160. Now let's do the same thing for a Roth. Here, let's say my tax rate is 20%. I earn $100, but I can only put $80 in because I have to pay tax. So the government takes $20 day one. And then again, over the next 10 years, it doubles. So I end up with $160, and when I take it out, I do not have to pay tax on it. So you can see those numbers end up being the same. In that case, would I rather pay tax on the seed or the harvest? It doesn't matter. I'm indifferent. So really the power of the IRA is when you're currently in a lower tax bracket today, so you can pay taxes at that low rate, and then later on you're thinking you're going to be in a higher tax bracket. But for many of us, the reverse is true, which is why many of us have non-Roth accounts, right? If you're paying 40% tax now, you'd rather not pay the government today, let that money grow, and then pay later at the 20% tax bracket in my example. So let's talk about some things that are really important though, because in my analogy, when I put the money into the Roth IRA, I only put $80 in. But if you have excess money that you can save, the nice thing about a Roth is, let's say that you can put in the max into a Roth. So let's just say for the sake of argument that number is $10,000. If you put $10,000 into a Roth IRA and $10,000 into a regular IRA, well, it's as if you're putting more money in, because that $10,000 that you put into a regular IRA, the government's kind of partners with you on that, right? The government, in my example, owns 20% of that account. So you get access to the $8,000, but you don't get access to the $10,000. The government has that. Where in the Roth, I put $10,000 in, and it's all mine. So it enables you to put more money in early on. So I think a lot of people spend a lot of time focusing on this, and rightfully so, because the tax savings and the tax difference can be substantial, and it's worth looking at. But in general, if you think your tax bracket while you're working and while you're retired is going to be about the same, then you're kind of indifferent. One of the things is a regular IRA has required minimum distributions, and as I record this, Roth IRAs, Roth 401ks, do not have that. So that is an advantage. But the challenge with the required minimum distribution isn't taking the money out. You'd probably prefer not to until you decide you want to take the money out. But the challenge is it can kick you into higher tax rates. So one of the strategies in retirement and why having a Roth IRA and a regular account can be beneficial, as well as having just a regular taxable account, like most people have a savings or a checking account at their local bank. The reason it can be beneficial to have all three of those accounts is the U.S. government has 7 different tax brackets. And if you can get your money out of those accounts and keep the blended tax rate at the 2 lowest rates, which are 10% and 12%, then you're taking money out at a very inexpensive rate. Most of us would be happy. We'd prefer to pay 0 federal tax, but most of us would be happy if we could access money and only pay 10 to 12% tax on it. So the 7 tax brackets in the United States are 10% and 12%. And then it jumps to 22%. So this taking money out at 10 and 12% would not be so powerful, except for the fact there's a big jump. It goes to 22%, 24%, and then there's another big jump to 32, 35, and 37%. So one of the strategies is what we call filling up those lower tax brackets, that 10%, that 12%, taking advantage of the standard deduction, which for a married couple is almost $30,000, $29,200, and for somebody filing single, the standard deduction is $14,600. So if you can take your money out of your accounts in retirement, and even technically that's like an 8th tax bracket, which is kind of 0%. So if you can get your money out at 0%, at 10%, or 12%, you're likely in a really good situation. Again, you'd like to keep your rate low, but what we're trying to do is avoid things that put us in a situation where we're triggering that higher tax bracket. So we spend a lot of time, financial advisors and people getting ready to retire spend a lot of time thinking about these 3 buckets, right? The Roth, the non-Roth, and the taxable account. And I think if you still have time, if you have 10, 20, 30 years until you retire, then thinking about where you want the money to be and which one of those buckets at which time can be really valuable. But then, even though you say, okay, strategically, let's say you want to have a third in each, if you're in a high tax bracket now, and you think it'll be lower, well, you're probably going to end up with of those 3 buckets, you're going to end up being heavy on the regular IRAs and the regular 401ks. And that's where being able to do conversions can be nice. But, this is more of the technical side of things, preparing for retirement. And the mental side of things can be every bit as challenging and important, because so many people skip through the youth of their senior years, their 50s and their early 60s, and they're just on default to retire at 65. But unfortunately, many of us are going to lose our health much sooner than what we think. The World Health Organization does studies of different countries, and here in the United States, the average person loses their health at 67.1 years. That's just 13 months after when people retire. So as much as this video has been about the numbers, the mental game is every bit as important, which is why I made this video here, which is called Retiring at 65, Why That Might Be a Big Mistake. Thanks for watching this one, and I'll see you in the next one. Bye-bye.